Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Listen, you know that we specialize on taking a little and doing a lot with it. What we want to do right now is get rid of this loan, and it doesn't matter what you call it, we're going to be calling it gone in a very little time with very little money. But before we get into that, like, share, and subscribe so that everyone around the world can know the power of velocity banking. Now, as is our custom, let us go over the loan that we have, okay? And kind of break it down, maybe in a way that you know, maybe in a way that you don't know, but we don't want to hide anything from you in this, okay? Because a lot of times lenders try to hide what they're doing, okay? We have a $36,000 loan at 15%. That's going to equate to about $760 each and every month. Now, that's very important, all right? Look at these numbers. It's important that we get persuaded, not by stories, right? Not by someone's testimonial, but let's be persuaded by the numbers and the numbers alone, okay? This is a loan, and it is for 6 years. 6 years loan. Now, remember that minimum monthly payment. A lot of us take for granted that minimum monthly payment, and perhaps we think that the whole amount is going towards that principal. But does it? Is that how loans work? No. Why is that? Well, because the interest rate, or the cost to borrow money, that's what interest rate is at 15%. And many times when that interest rate is higher, guess what else is higher? The minimum monthly payment. When that interest is lower, guess what else is lower? The minimum monthly payment. Now, why that fluctuation? Why? Because that interest rate means there is a cut that the bank takes, all right? And that cut is divided in this scenario this way, all right? Here we have the interest in the first month, okay? It's $450 of the $760 is going towards the bank, okay? And when you get to the principal, $310 is actually going to the principal. So remember, it's not $760 that's going to the principal. This number right here. It's only $310 that is going to the principal. Now, I want to take a time out here because I know maybe some of you are sad, maybe you are perturbed, disturbed, because your interest rate looks like that, right? Maybe your credit is a little risky. Not that it's bad, it's a little risky. I want to share with you a method that is going to make sure that you pay way less than that interest rate says, okay? So if you are doing and implementing velocity banking, that means your rate could be 5%, maybe 3%, maybe 2%. It's all in how you want to attack this loan. You see, a lot of us were told to cut up our credit cards instead of using or leveraging the credit that we have. I want to share with you maybe another method that you haven't known before. Is that okay? All right, let's go ahead and continue on here. Do you see the differences in these amounts when we go to the first month, the second month, the third month, and then the fourth month? Do you see the differences there? Let's go ahead and just count it, okay? $4 difference between the first and second month, right? Another $4 difference between the second and third month, and then another $4 difference between the third and fourth month. Now, what I want to do is I want to share with you a secret, and that is, as you continue to hammer this principle, the amount that goes towards the principal goes up, and the amount that goes towards the interest goes down. Do you know why that is? Because as you're paying the principal off, there is less and less for this interest rate monster to eat, right? Because the principal is the host and the interest rate is the parasite. So the smaller the principal, the smaller the parasite. Let me share with you what I mean. Do you see how it says 450 in the interest column and 310 in the principal column? Okay, now let's go to the second month. This decreased by $4. Where did that $4 go? Because it didn't just disappear. No, it transferred. Watch this. From this side to this side. Because we see this one went down $4 from the 450, and this one actually went up in how much is going towards the principal by $4. And it does that month after month after month. Now, if you continue on with the bank cycle, guess what you're going to get? What you always got. And you're going to be out thousands of dollars, unnecessary dollars, and oh, by the way, it's going to take you 6 years to actually get out of that loan because you're paying the way they want you to. Now, let's go ahead and share with you what that total interest becomes if you want to continue to do things the way you've always been doing them, the traditional banking way, or as I say, the TB way. Now, before I share with you the total interest and the total dollars that you'll be missing out on if you continue to pay your loans this way, I want you to know that time is a commodity that you can't get back, all right? And we need to trade our dollars for time and not our time for dollars, all right? Watch this. $18,807. That is on top of the principal, all right? So it's going to be $18,807 plus the $36,000. Now, I know what you're thinking. You're thinking, CJ, I do not want to be out that much. I can't even save that much in 6 years. Well, what if I told you that you could, right? That you could actually save yourself a whole bunch of trouble. You don't have to shell out unnecessary money to the bank. Let me share with you another way. This is a brand new way, perhaps for you, to get rid of your debt faster than ever before. And we're not talking about throwing away your credit cards, all right? You don't have to do that. You see, if you have $500, and this doesn't matter if it's in a checking account, in your credit line, right? That's right. You can even use your credit line. Savings account, doesn't matter. With this extra $500, right, being deployed, mind you, to your principal each and every month, you can drastically reduce this number, right, that we got from the old way of banking. Remember, folks, we are no longer in the horse and buggy stage of life. So why are we still banking like we are still in those horse and buggy stages, right? This is the 21st century. We need a new way of banking. We need a more efficient and effective way of banking. We're actually going to get more into that. But I want you to look at this and see if this can better work for you. You're only at the end of not 6 years, folks, okay, but actually 3 years. You are out of a $36,000 loan, $8,807. Actually, it's a little less than that, but I don't want to beat up on anybody, right? And notice, right, what the amortization table looks like when you are deploying strategically the $500 towards the principal. Now, I know perhaps $500, that's still a lot of capital to eat up. Okay, it's not that you don't have it, you simply don't want to deploy that much capital at that time. That's okay, because you can split it up during the weeks, right? There are typically 4 weeks during the month. And so if you want to, you can actually split up the weeks, right? So you don't have to do all $500 on a particular day. On a particular day you get paid, okay? You can split it up. Maybe 200 one week, 200 the next week, then 100, right? The following week, right? Whatever it is, we want you to deploy that $500 specifically. So set it aside, sanctify it for the principal payment. Because it's in paying down the principal strategically that you actually erase all that interest. You see how much interest you save? You save what? About $10,000 in interest by simply deploying your money the strategic way. All right? And, oh, by the way, after the third year, what happens to that $760 per month? Do you have maybe a dream car that you want or need? Perhaps you want to deploy it towards an investment so you can make not $760 a month, but maybe $1,000 a month. I know one lady, she said, I'm going to go ahead and invest it, right? I got a business to tend to. I said, there you go, right? It's all about capturing this cash flow. We need to get out of the mindset of strictly accumulation. And it's not either or either, right? It's both and. We need both accumulation, right, on the saving side, and cash flow on our business side or on our financial side, right? So it's cash flow management that's what we're talking about here, all right? If you're looking to the amortization table, you'll notice a stark difference when we go into the second month. Yes, we're deploying the $500 towards that principal. That's why it's $810, right? $450 towards the bank. Remember before, the bank was giving more than us, right? And that's not the case anymore. We are spending more towards us than we are towards the bank. Us meaning that loan is getting paid off rapidly. Now, I want you to notice the difference between the first month and the second month. Do you see that? Yeah, it's about an $11 difference, isn't it? About an $11 difference. Now, why is that? Well, because what we're doing here is we are deploying that $500, getting rid of the principal, and the interest feeds off of the principal, okay? And so as we are continuing to deploy that, what is happening to the interest? It shrinks the interest dramatically. And that's why you're seeing a $10 difference between the second month and the third month, $10 difference here and here. Why? Because again, that $10 goes from the bank side to our side. And that is exactly what we want. All right. Now, don't forget, if you have multiple loans, there is a simple formula that you can use so that you know which loan that you need to pay off first. Okay. Let's go ahead and share with you that formula right now. And that formula is called, that's right, the cash flow indicator method. Now, that is going to be CFI equals LB divided by the minimum monthly payment. So go ahead, stack all your loans within this formula. It's going to share with you what is the most inefficient loan, right? The one that's closest to zero, that's the loan we want to pay off first, okay? Because remember what we're working with here. We're working with a line, okay? This is the zero, excuse me, the 50 is right here. The 100 is over here. And of course, this is the zero. All the loans that is the closest to zero, we want to make sure we are paying them off first. So anything from 0 to 50 is the danger zone. That's right. Anything 51 to 99 is the caution zone. That's right. And then 100 and above is the freedom zone. That's right. Put all of your loans in there and you'll be good to go. All right. Folks, if you want more strategies like this, listen, all you've got to do is let me know. Go ahead and sign up, right, for our free debt-free date. I'll give you your debt-free date for free, all right? And we're going to make sure you are on the road to financial freedom. You see, we need to spread this information all over the world. Because, you know, there are certain products like the Money Max account that's not available worldwide. But you know what is available worldwide? Knowledge. And that's what we aim for, all right? I want you to get this. Go ahead and take a screenshot of this. Make sure that your friends and your family know that there is another way to pay off these loans. There's another way to pay down those credit cards. You're not going to be looking at your credit cards the same way you have been. They're not bills, because you can pay, borrow, and borrow. What bill can you do that with? God bless you, and we'll see you in another video.